Let me ask you one question before we start. What does it take to bring down a bank that survived Napoleon Bonaparte, the American Civil War, and 2 world wars? Not a financial crisis, not a government scandal, not even a market crash. Just one man, one hidden account, and an institution so blinded by greed and arrogance that it never thought to ask a single question. This is the story of Nick Leeson, the working-class boy from Watford who became the most dangerous trader in the world, and how he destroyed Barings Bank, Britain's oldest and most prestigious financial institution, in less than 3 years. Nick Leeson wasn't supposed to be here. He grew up in Watford, a quiet town just north of London, the son of a plasterer. No family connections, no Ivy League degree, no trust fund waiting for him at 18. While the City of London was largely a playground for prep school alumni and Oxford graduates, Leeson had 2 A-levels and a hunger that couldn't be taught in any classroom. He joined Coutts Bank as a clerk in 1985 at 18, then Morgan Stanley. Then, in 1989, he landed at Barings Bank, the crown jewel of British finance, founded in 1762, the bank that helped finance the Louisiana Purchase and counted the British royal family among its clients. He was a back-office settlements clerk, paperwork, confirmations, reconciling trades, unglamorous work that most ambitious young bankers avoided. But Leeson threw himself into it completely, and people noticed. He was sharp, tireless, and had an almost instinctive feel for how the numbers fit together. By 1992, Barings sent him to Singapore to help set up operations on the Singapore International Monetary Exchange, CIMEX. And here is where the story really begins. Because in Singapore, Nick Leeson wasn't a clerk anymore. He was the floor manager. He was executing trades. He was making money. Fast, impressive, seemingly effortless money. In 1993, he reportedly generated around £10 million in profit for Barings, nearly 10% of the bank's total annual earnings. In 1994, the number was even higher. Back in London, the bosses loved him. He was their golden boy, the rough-edged kid from Watford who had cracked the Asian markets and was printing money like it was nothing. Nobody asked how. And that, right there, is the first crack in the foundation. Because the most dangerous moment in any institution isn't when someone starts lying. It's when everyone around them becomes too comfortable to ask questions, when success becomes a shield, when results silence risk management. Nick Leeson was 26 years old, running a trading floor in Singapore with almost no meaningful oversight from London. They had handed him the keys to the kingdom, and he had already begun to bury the bodies. To understand how Nick Leeson pulled this off, you need to understand one thing about the financial world in the early 1990s. It was the Wild West. Derivatives trading was exploding. New financial instruments, new markets, new exchanges were opening up across Asia at a pace that regulators, and frankly, most bank executives, could barely keep up with. If you were young, aggressive, and willing to work in Singapore instead of London, you were given enormous latitude, because the people above you didn't fully understand what you were doing. And as long as the numbers looked good, they weren't going to admit that. This was the world Nick Leeson walked into in 1992. Barings sent him to Singapore with a clear mandate: set up and run their operations on CIMEX, the Singapore International Monetary Exchange. The strategy was straightforward, at least on paper. Leeson would execute a form of arbitrage trading, exploiting tiny price differences between Nikkei 225 futures contracts listed on CIMEX in Singapore and identical contracts listed on the Osaka Securities Exchange in Japan. Arbitrage, in theory, is one of the safest strategies in finance. You buy low on one exchange, sell high on the other, and pocket the difference. The positions cancel each other out. The risk is minimal, the profits are modest, but consistent. It sounded boring. It was supposed to be boring. But here's what made Leeson's situation anything but ordinary. When he arrived in Singapore, Barings gave him a role that should never, under any circumstances, belong to one person. He was appointed general manager of the trading floor. He directed and executed trades. He was the front office. And then, because Barings was cutting costs and trusted him completely, he was also put in charge of the back office, the settlement and reconciliation team, the people whose entire job was to independently verify and check everything the traders did. In every serious financial institution, these two roles are kept strictly separate. The front office takes the risks, the back office checks the risks. It's a basic internal control, the financial equivalent of having one person bake the food and a different person inspect it before it goes out. Barings handed both jobs to the same man. It was like asking the magician to also run the audit on his own tricks. At first, everything looked spectacular. Leeson was confident, decisive, and commanding on the trading floor. His team respected him. His numbers in 1993 were extraordinary. Tens of millions of pounds in profit flowing back to London. Senior management at Barings pointed to him as proof that their Asian expansion was working. He was promoted, praised, rewarded. And nobody in London had the operational knowledge or the will to scrutinize exactly how he was doing it. Risk reports were filed, compliance boxes were ticked, but the real picture of what was happening on that trading floor in Singapore, it was invisible to the people who should have been watching. There was no meaningful supervision, no independent verification, no one in a senior position who truly understood the mechanics of what Leeson was executing day to day. He had complete control over the trades. He had complete control over the records. He had the ability to move money, hide positions, and report whatever numbers he chose. Barings Bank had, without fully realizing it, created a perfect environment for fraud. All it needed was a trigger. That trigger came in the form of a small, almost trivial mistake, made not by Leeson, but by a junior colleague on his own team. A mistake that Leeson decided to quietly bury. A mistake that would eventually cost £827 million. It started with £20,000. Not a billion, not even a million. £20,000. A rounding error by the standards of an international trading floor. A mistake made by a junior trader on Leeson's team named Kim Wong, who sold contracts she was supposed to buy. A simple, honest error. The kind of thing that happens in busy trading environments every single day. The normal procedure was straightforward. Log the error, report it to London, absorb the small loss, move on. Banks have error accounts specifically for this purpose. It's routine. It's unglamorous. Nobody gets fired over £20,000. But Nick Leeson didn't report it. Instead, he did something that would change everything. Buried inside Barings Singapore systems was a dormant account, number 88888, originally set up to handle a minor technical issue years earlier and then forgotten. It sat there, inactive, invisible to London's reporting systems, largely because Leeson's dual role meant he controlled what got flagged upward and what didn't. He moved the loss into account 88888, just temporarily, he told himself, just until he could trade his way back to flat. He'd cover it quietly, close the account, and no one would ever know. It was the kind of reasoning that sounds almost rational in the moment. The gambler's first bet on credit, convinced the next hand will fix everything. It didn't fix everything. It fixed nothing. The losses in 88888 grew. Small bad trades, minor misjudgments, the natural friction of a market that doesn't always move the way you expect. Each one quietly redirected into the hidden account, rather than reported honestly. And because Leeson controlled both the trading records and the back office reconciliation, he could structure the paperwork to make 88888 invisible in the report sent to London. He was essentially marking his own homework. And the deeper the hole got, the more pressure he felt to trade his way out of it, which meant bigger positions, higher stakes, more risk. Which, when those trades went wrong too, meant even bigger losses that needed hiding. This is a pattern that defines almost every rogue trader story in history, and it has a brutal internal logic. You can't come clean after the first cover-up, because now you're not just admitting a trading loss, you're admitting to fraud. The cover-up itself becomes a crime you're most afraid of, so you keep going, you keep betting, you keep telling yourself that one big win will erase it all. By the end of 1993, account 88888 held losses of around £2 million. By the end of 1994, that number had exploded to over £200 million, and London had no idea. None. Part of what makes this story so extraordinary is not just what Leeson did, but what Barings failed to do. Throughout 1993 and 1994, there were red flags. Auditors flagged concerns about the dual role. Internal risk reports noted irregularities in margin funding requests. Leeson kept asking London to wire large sums of cash to cover his positions on Cymex, and the explanations he gave were vague at best. At one point, Barings' internal audit team visited Singapore and produced a report that explicitly identified the conflict of interest in Leeson's dual front and back office role. They recommended it be changed immediately. The recommendation was noted, and then ignored, because the profits looked too good, because nobody wanted to disrupt the golden goose, because challenging Nick Leeson meant admitting that the people above him hadn't been watching closely enough, and that was an uncomfortable truth nobody at Barings was willing to sit with. So the money kept flowing to Singapore. The losses kept piling into 88888, and Nick Leeson kept walking onto that trading floor every morning, perfectly composed, acting the part of the man who had everything under control. Until the earth literally shook. At 5:46 in the morning on January 17, 1995, a 6.9 magnitude earthquake struck the city of Kobe, Japan. Over 6,000 people were killed. Entire neighborhoods collapsed. It was the deadliest earthquake to hit Japan in over 70 years, and the human cost was devastating beyond measure. But inside the trading floors of Asia, within hours of the disaster, a different kind of catastrophe was beginning to unfold. Japanese markets went into freefall. The Nikkei 225, Japan's benchmark stock index, dropped sharply as investors absorbed the scale of the destruction. Uncertainty flooded the market. Volatility spiked. And Nick Leeson, already sitting on over £200 million in hidden losses, was on the wrong side of almost every position he held. To understand what happened next, you need to know what Leeson had been betting on in the months leading up to Kobe. He had moved far beyond simple arbitrage, the safe, modest strategy he was originally sent to Singapore to execute. By late 1994, desperate to generate the kind of returns that could claw back the losses buried in account 88888, he had taken enormous speculative positions on the Nikkei. Specifically, he was betting that the Japanese market would rise, or at minimum remain stable. He had also sold a large number of options contracts in a structure traders call a short straddle, essentially a bet that the market would stay calm and not move dramatically in either direction. It was a strategy that generated steady income in quiet markets. It was a strategy perfectly designed to be destroyed by an earthquake. When the Nikkei dropped after Kobe, Leeson's losses didn't just grow, they accelerated. Every point the index fell multiplied his exposure across thousands of contracts. The short straddle positions, meant to profit from stability, were now hemorrhaging money with every passing hour. A rational response would have been to cut the positions, accept the losses, stop the bleeding. Nick Leeson did the opposite. He doubled down, then doubled down again. His logic, if you can call it that, was that the Kobe earthquake was a temporary shock, that the Japanese market would recover, that if he could just hold on long enough and accumulate enough contracts at depressed prices, the eventual rebound would wipe out everything. It was the same thinking that had gotten him here in the first place. The gambler who has lost everything at the table, convinced that one more bet is the rational move. The sunk cost fallacy taken to its most catastrophic extreme. Throughout January and into February 1995, Leeson bought Nikkei futures contracts on a staggering scale. At the peak, he held positions on over 61,000 futures contracts, representing exposure worth billions of dollars. He was no longer hedging. He was no longer arbitraging. He was making one of the largest single-directional bets in the history of derivatives trading, financed entirely by money wired from London. And London kept sending it. This is perhaps the most breathtaking part of the entire story. To maintain his positions on Cymex, Leeson needed to post margin, essentially a cash deposit to cover potential losses on his open contracts. As the positions grew and the market moved against him, the margin calls grew too. He needed hundreds of millions of pounds, and he needed it regularly. He requested it from London. He fabricated documentation. He invented a fictional client, a firm called Spear, Leeds, and Kellogg, and claimed the margin payments were being made on behalf of this client who would reimburse Barings shortly. London wired the money. Every time. Without independent verification, without speaking directly to the supposed client, without anyone stopping to ask why a Singapore arbitrage desk needed this much cash this consistently with this little explanation. In total, Barings sent over £700 million in the final months. The Nikkei did not recover. It kept falling. And by mid-February 1995, the number inside account 88888 had passed £827 million, exceeding the entire capital base of Barings Bank. The game was over. Nick Leeson knew it. He just hadn't told anyone yet. On the morning of February 23, 1995, Nick Leeson did not show up to the trading floor. Neither did his wife, Lisa. What they left behind was a desk, a phone, and a single handwritten note placed where anyone could find it. It contained no detailed explanation, no justification, no elaborate farewell. Just 3 words: "I'm sorry." While Leeson and his wife boarded a flight out of Singapore, destination Kuala Lumpur, then Brunei, then ultimately Europe, the back office staff at Barings began making calls they had been putting off for days. Something wasn't adding up. The margin requests from Singapore had become so large, so frequent, and so poorly documented that even the most compliance-averse managers in London could no longer look away. When they finally pulled the full records and looked directly at account 88888, the account that wasn't supposed to exist, the account that never appeared in the reports sent upstairs, the room went silent. £827 million in losses. To put that number in context, Barings Bank had approximately $440 million in total capital. The losses in one hidden account were nearly double everything the bank owned. There was no rescue possible, no asset sale, no emergency fundraising, no partner willing to absorb a hole that size over a weekend. Barings Bank was not just in trouble, it was already dead. It just hadn't been announced yet. The calls went to the Bank of England, to the Treasury, to every major financial institution in the City of London that might conceivably be willing to mount a rescue. Through the weekend of February 25th and 26th, emergency meetings were held at the highest levels of British finance. The Governor of the Bank of England, Eddie George, personally led the effort to find the buyer or organize a bailout. One by one, the potential rescuers looked at the numbers and walked away. The losses were too large. The paperwork was too chaotic. Nobody could be certain that $827 million was actually the final number. And in situations like this, uncertainty is lethal. When you can't see the bottom of the hole, you don't jump in. By Sunday evening, it was over. On February 26, 1995, Barings Bank, founded in 1762, financier of the Louisiana Purchase, banker to the British royal family, survivor of 2 centuries of wars and crises and market collapses, was declared insolvent. The entire institution was sold to the Dutch banking group ING. The purchase price was £1, £1 sterling, for 233 years of history. Meanwhile, Nick Leeson was running. He and Lisa traveled through Southeast Asia and then flew to Frankfurt, Germany, apparently hoping to eventually make it back to Britain, where Leeson believed, wrongly, that his legal exposure might be more manageable. But his face was already on the front page of every newspaper in the world. The story had broken with a force that financial journalism rarely sees. A rogue trader, a hidden account, a 233-year-old institution wiped out overnight. He was arrested at Frankfurt Airport on March 2, 1995, just 8 days after leaving that note on his desk in Singapore. He was extradited back to Singapore, tried, and in December 1995, pleaded guilty to 2 counts of deceiving the bank's auditors and cheating the Cimex exchange. He was sentenced to 6.5 years in Changi Prison, one of the most notoriously harsh prison environments in the world. While serving his sentence, he was diagnosed with colon cancer. He survived. He served 4 years before being released in 1999 on grounds of good behavior. The human wreckage around him was harder to quantify. Over 1,000 Barings employees lost their jobs overnight. People who had nothing to do with Singapore, nothing to do with derivatives, people who had simply built careers at a bank they believed was solid and permanent. Their pensions, their redundancy packages, their professional futures, all of it thrown into chaos by one man and the system that enabled him. Peter Baring, the bank's chairman, reportedly said in the aftermath that he had thought it inconceivable that a trader could accumulate losses of this magnitude without being detected. He was right that it was inconceivable. He was wrong that it was impossible. Nick Leeson walked out of Changi Prison in 1999 with a scar from cancer surgery, a book deal, and a story that the financial world was already beginning to misremember. The misremembering went like this: one rogue trader, one bank, one moment of exceptional greed. A freak event, an anomaly, the kind of thing that happens once and then gets fixed. It was a comfortable story. It was almost entirely wrong. Because the real lesson of Barings had nothing to do with Nick Leeson's individual psychology. It had nothing to do with how clever or audacious or dishonest one man from Watford managed to be. Leeson was not a criminal mastermind. He did not deploy sophisticated technology or elaborate schemes. His methods, examined closely, were almost embarrassingly simple. He had one hidden account, he controlled his own oversight, and the people above him never asked the right questions. That's it. That's the whole mechanism. The real villain of the Barings story is not a person. It's a culture of willful blindness, of profit celebrated without curiosity about its source, of institutional arrogance so deep that a 233-year history felt like protection against any possible future failure. Barings didn't fall because of what Leeson did in the dark. It fell because of what everyone else refused to see in the light. And then it happened again. In 2008, Jérôme Creviel, a junior trader at SOC Generale in Paris, was found to have accumulated unauthorized positions worth an almost incomprehensible 50 billion euros. His losses to the bank reached $4.9 billion. Like Leeson, he had an intimate knowledge of back-office systems from an earlier role. Like Leeson, he exploited gaps in oversight that should never have existed. Like Leeson, he had been posting strong enough numbers that senior management had little appetite to scrutinize the details too closely. In 2011, Kweku Adoboli, a trader at UBS in London, lost $2.3 billion through unauthorized trading hidden in fictitious hedging positions. He too had back-office experience. He too exploited a system that trusted reported numbers without independently verifying them. 3 different traders, 3 different banks, 3 different decades. Almost identical methods. If Barings was a freak event, what do we call the second one and the third? The regulatory response to Barings was real and significant. Cimex and other exchanges tightened their rules around position reporting. The Bank of England overhauled its supervision of merchant banks. Firms across the industry were told, firmly, to separate front and back office functions. New internal control frameworks were drawn up, debated, implemented. And yet, the controls that should have caught Leeson in 1993 were not exotic or complicated. They were basic. They were known. They were simply not applied. Because the results looked good. And in finance, good results have always had a way of making inconvenient questions disappear. This is the structural problem that no regulation has fully solved. When someone is making money, the institutional incentive is to protect them from scrutiny. Compliance becomes a performance rather than a function. Risk management sits in a meeting room while the actual risks accumulate on a trading floor 12 time zones away. Money in large enough quantities buys silence from the people who should be asking questions. Nick Leeson today is a curious figure. He lectures on risk management. He speaks at corporate events about the psychology of bad decisions, the mechanics of cover-ups, the moment a small lie becomes an irreversible catastrophe. He is, in a strange way, the most qualified person in the world to explain exactly how it happens. He has said more than once that he never intended for any of it to go this far, that the first cover-up felt minor, that each subsequent step felt like a temporary measure on the way back to solid ground. That is perhaps the most important lesson of all, and the most unsettling one. Because the road from £20,000 to $800 million didn't require malice at every step. It required a series of small decisions, each one feeling like the only available option, each one narrowing the exits a little further. The catastrophe wasn't built in a day. It was built in the silence between all the questions nobody asked. And somewhere right now, in a trading floor, or a boardroom, or a back office system in a city you've never heard of, the next account 888888888 is already open. The only question is, who's watching?